More worrisome are the side effects that the sharp policy tightening of the last 12 months is starting to have on the financial sector. We have repeatedly warned this would not be an easy ride. Following a prolonged period of muted inflation and low interest rates, the financial sector had become too complacent towards maturity and liquidity mismatches. Last year's rapid policy tightening triggered sizable losses on long-term fixed income assets and increased bank funding costs. The brief instability last fall in the United Kingdom's gilt market and the recent banking turbulence in the United States illustrate instead that significant vulnerabilities do exist both among banks and non-bank financial institutions. In both cases, financial and monetary authorities took quick and strong action and so far have prevented further instability. Broader markets have remained calm and volatility has been contained, including for emerging and developing economies. Increasing funding costs and the need to act more prudently, however, may push banks to cut down lending further. In our World Economic Outlook, we explore such a scenario and find that it would lead to an additional 0.3% reduction in output this year. Yet, the financial system may well be tested even more. Nervous investors often look for the next weakest link, as they did with Credit Suisse, a globally systemic but ailing European bank. Financial institutions with excess leverage, credit risk, or interest rate exposure, too much dependence on short-term funding, or located in jurisdictions with limited fiscal space could become the next target. So could countries with weaker perceived fundamentals. A sharp tightening of global financial conditions, which is sometimes called a risk-off event, would have a dramatic impact on credit conditions and public finances, especially in emerging market and developing economies. It would precipitate large capital outflows, a sudden increase in risk premia, a dollar appreciation in a rush towards safety, and major declines in global activity amid lower confidence. In such a severe downside scenario, global growth this year could fall to about 1%, an outcome whose probability we estimate at about 15%. We are therefore entering a tricky phase during which economic growth remains low by historical standards, financial risks have increased, yet inflation has not decisively turned the corner.